Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at the role of the private sector and government regulation in the economy and how each of these relates to trading. In today's lesson we're going to look at a second way which the government influences the economy and therefore the market, which is through something which is known as fiscal policy. So let's get started.
Okay, so fiscal policy for our purposes can be defined very simply as anything related to government spending and taxation. Before looking at the fiscal policy role of government in trying to influence the economy, one must first have an understanding of the business cycle. So that's what we're going to look at first. For a number of reasons which are widely debated, the economy goes through repeated periods of growth and contraction over time, which can be broken down into the following phases. A contraction where economic activity and growth slows and can turn negative. A trough where the economy stops contracting and a new expansion begins. An expansion or the speeding up of economic growth, and then a peak where the growth of the economy maxes out and begins to turn downward. We could spend many months going over and debating why this is, but for our purposes it's simply important to understand that while the timing and length of each of these phases has varied widely and is very unpredictable, the above pattern does repeat itself over and over again throughout history. This is important for us as traders to understand, as different phases of the economy or the business cycle and changes in people's forecast of where the economy is in those cycles is arguably the greatest factor which affects the price level of every market. Prior to the Great Depression, the U.S. government had a pretty hands-off approach in regards to the business cycle. They let things play out as they may. But since the Great Depression, however, the government has played a much more active role in the economy, with its stated goals being to act to facilitate full employment and price stability. To help understand each of these goals and the balancing act that goes on between them as they often conflict, let's look at how each relates to the different phases of the business cycle. During an expansion, we start to see more people employed as companies begin to sell more goods and services and need to hire more people to keep up with demand. So it's party time and the politicians are all smiles during this time. As economic growth picks up, more and more people are employed. They're making more money, and so they're spending more money that they're getting from their paychecks, and this can cause prices to rise, which is something this is also known as inflation. Because of this effect on prices, the government's primary concern here will normally be trying to keep prices stable and inflation in check without hurting the economic growth. The two things they can do here in regards to fiscal policy to try and keep prices in check and inflation at bay are, number one, they can raise taxes, because by raising taxes money is taken away from the consumer, who now has less money to spend, and helping to counteract the demand that's pushing prices up and causing inflation. Or number two, they can reduce government spending, which also has the same effect of pulling some of the demand out of the economy that may be pushing prices higher, and therefore counteracting that inflation that may be taking place there. So I'm generalizing things and making things much more simple than they actually are, just because it's important at this point that we just have a basic understanding. So, these things are pretty complicated, and we're going to learn more and more about them as we go into more and more of the fundamentals of the difference. In general, this is how things work. It's important to keep in mind that it is a little more complex than I'm making it. During a peak, when we start to see employment and the amount of goods and services produced and sold by companies begin to level off, at this stage the government normally becomes more concerned with preventing a deep contraction, and you can see here there's a little bit of concern on the politicians' face because they can see that the growth is starting to level off and maybe heading towards a contraction. So at this stage, the two fiscal policy tools that can be used to counteract and hopefully keep the economy from going into a contraction or a recession even, or they can decrease taxes, so do the reverse there, which puts more money in the consumer's pocket and is going to increase demand. And this is what we've seen recently with the tax stimulus, the rebate checks that we're all going to hopefully be receiving soon from the government as part of the stimulus plan. Or they can increase government spending, so they can start new projects like roads and spend more on education and defense and things like this, okay, and add demand that way, okay? During a contraction, we start to see employment and the amount of goods and services produced and sold by companies start to fall. The fiscal policy tools that the government has at their disposal here are the same two as mentioned in the peak phase, which are to reduce taxes or increase government spending. Things just become a little more urgent because the economic growth has actually started to slow or even contract at this point. Although there are exceptions, normally at this stage, inflation is not a concern as demand is falling, so the government can be more aggressive than they can during a peak. There was one exception to this fairly recently in the 1970s, where you had large inflation along with slowing growth, something known as stagflation, and you can see how that will be a problem from a policy standpoint as far as what to do there, because you're sort of caught between a rock and a hard place. One other thing that is a potential concern during this time is something which is known as deflation, which is where prices actually begin to fall as demand is reduced. And this can be a large problem which sets off a deflationary spiral where businesses slow or stop investing because the investment risk is perceived as higher than just letting the money appreciate due to the deflation. And that can be a real problem from a growth standpoint because we need these businesses investing, and people spending to keep the economy growing. Okay. During a trough, we start to see the employment level and the level of goods and services produced and sold by companies start to level off again. And during this phase, the expected action, if any, from the fiscal policy side would be to begin to reduce whatever policies have been put into place and help the economy grow as it moves into another expansionary cycle and the cycle repeats itself. While many believe that fiscal policy has shown to be an effective tool in regulating the business cycle, as government spending and taxation must be approved by both Congress and the President, managing the economy through the use of fiscal policy is normally seen as a lot more tedious than the second tool that government has at their disposal, which is something known as monetary policy. Okay, and this is going to be the topic of our next lesson, so we hope to see you then. For those of you who wish to learn more about fiscal policy, the business cycle, the different schools of economic thought on the subject, as well as things such as inflation and deflation, I've included a link to additional resources in the description section of the site if you're watching this video on YouTube, or just below the video if you're watching it on InformedTrades.com, because there is a lot more, or a lot you can go potentially for years learning about the fiscal policy side of things. Okay, as always, if you have any questions or comments, please feel free to leave them in the comment section below, and have a great day.